And joining us now in the studio is Martin Weber, Chair of Business Administration and Finance at the University of Mannheim. Hello. What do you make of the financial world right now? Is it back to square one?
It's actually not back to square one. It's another crisis. It's not the first crisis we had. We learned from the crisis, and we hope to get ready for the next one.
Okay. So you say we're in between two crises now, because I mean we hear that banks are obviously they haven't learned from the crisis. At least that's what we just heard in the report.
I think they've learned, but I mean from a pure logical point of view, we are always between two crises, and the unfortunate thing, we don't know what the next crisis will be. Okay,
there's some fatalistic outlook, which means that we also heard that the run for bonds will eventually come to an end at the end of this year. So that's probably when the next crisis is just around the corner?
No, I don't think it's around the corner as fast as you just mentioned, but we always had financial crises. You can go back to the Middle Age and we had financial crises, so there's no reason to believe that there won't be any financial crisis in the future.
But is there reason to learn from it? I mean, politicians have pledged that they would introduce more transparency, tougher regulations into the financial sector. According to what you tell us now, it's not really necessary because things won't change.
No, you will have a different financial crisis. I mean, the thing is, you want to regulate, you want to learn from the current financial crisis, but then something new comes up. You see, this financial crisis is not, we had all this sort of big bubble and so on in the 1990s. So we have overcome that problem. Now we have another problem. It's not a fatalistic. I think it's an empirical.
Okay, I see. We'll have to continue our talk, Martin Weber. Until now, thank you very much. In the meantime, let me ask another question, like whatever happened to the days when money in the bank was the best financial security you could ask for? The financial crisis has certainly destroyed a lot of trust in banks, and we know that they can go under, taking our savings and sometimes a whole state down with them. And when your friendly bank talks of a safe investment, you know, you should be suspicious. It's all the more surprising that some US banks have been reporting healthy quarterly figures with profits in the billions. Here's more.
The US banking giants are raking in the dollars again. From JP Morgan to Citibank to Goldman Sachs. They're reaping generous profits thanks to a simple but fail-safe trading strategy. People worldwide are looking desperately for safe investments. The banks provide them, especially in the form of state and company bonds. The banks are in effect selling these bonds.
They're paid a fee, so they trade them the way they would a commodity. And due to the huge volume which has currently been made available for the market and is needed by companies and governments alike, it's definitely an attractive and lucrative business.
But governments are getting deeply into debt by issuing these bonds, money intended to support the economy and save beleaguered banks. And the banks are even making profits from them. In the second quarter of this year, Goldman Sachs and JP Morgan earned the equivalent of almost 2 billion euros in profits. The Bank of America also did well, and Citigroup posted a whopping 3 billion.
That really surprised me. But several banks were out of the competition, so the remaining ones became stronger and were better positioned.
Wall Street is back. Analysts expect that bond trading will keep improving the major US banks' balance sheets until the end of the year.
So Wall Street is back in business, and I'm somewhat confused. Martin Weber, Chair of Business Administration and Finance of the University of Mannheim. You can probably tell me, how is it possible? Just a few months ago, banks were on the brink of bankruptcy. Now they're back alive and kicking. How is that possible?
I mean, first we should be happy that they're back alive and they're not making more losses. So, and if you think, as you pointed out, 3 billion, that sounds a lot of money, at least to me. But if you look at the overall balance sheet, it's not. I would say it's normal.
Okay, so if you put it in perspective, 3 billion for a bank isn't that much. Still, they're back in the black, which means, I mean, one is somewhat dubious now. Does it have something to do with tweaked balance sheets? I mean, there are new regulations that could make that possible.
As far as I know from the banks, but we have to ask the banks themselves, is 2 or 3 of them are really earning money by their original business. And then you have additional things. You sell a unit and so on, so you make extraordinary profit. And that's what is showing up in the balance sheet right now.
What happened to all the toxic assets that have been put on ice, but they could come back and haunt us?
They're on ice, and it's good that they're on ice, but on the other side, it's not clear how toxic they are, and the future will tell. And of course, we have to make provision for them, but hopefully we luck out. But it's certainly clear, and you can't tell, honestly.
Well, but you can certainly tell that I'm somewhat dubious, which is natural in this day and age, because one thing is certain, a lot of trust has gone out of the window. Let's hear what some investors have to say.
I had some shares and was given really bad advice. I have to say absolutely appalling, because I actually wanted safe investments, but then they convinced me to invest in funds, and that was that.
I can't imagine the advice they give has improved. Investments should be more broadly spread, and bank employees need much better training.
I don't believe the banks give better advice. At most, they're forced to if they encounter a skeptical customer, but they don't do it off their own bat.
Martin Weber, business administration and finance are your fields of expertise at your university in Mannheim. How do you rate the credibility of banking experts and advisors, consultants, you name it?
I think they try hard, but of course they can improve.
They can improve. Perhaps they could improve if they read your book. I understand you co-written a guidebook which tells you how to invest, or how investment can be incredibly easy. Perhaps you could share some nuggets of your wisdom with us?
Of course, some of them bought the book, and I'm sure that they get better investment advice, a little bit more serious. I mean, the key problem in investment that the future is uncertain. You can't predict the stock market. People who predict the stock market just lie, or they think they can, but they can really not do it. So you have to cope with the uncertainty. That's what the book is about. And you do it by diversification, by taking your own human capital into account, by knowing how to save and when to say what, and to solve these type of problems.
So in these times right now, would you advise somebody to invest, or would you say be cautious, stay away until times are safer?
That was a very good question for you to try to trick me. It's even these times I don't know what the future will be. And so in these times, the future is the same of uncertain as the other time. So you should always invest according to the risk you can take and then broadly diversify. That's the key idea. And it hasn't changed before, after, or in the crisis.
Is there anything specific you would suggest one should invest in?
You should cope with the cost. You should invest in a fund that is really cheap and that offers a wide diversification. This is the way to go these days.
Martin Weber, thank you very much for joining us.
Thank you.